What if I told you there's a small cap that's up nearly 150% in a year that builds the actual supercomputers powering India's AI ambitions, is completely debt-free and yet trades at 120 times earnings? That's Netweb Technologies. Today we are doing a full teardown. The business, the blockbuster numbers, the red flags, and what the chart is telling us. Stick around to the end for the verdict. So first, what does Netweb actually do? Incorporated back in 1999 and based in Faridabad, Netweb is one of India's leading high-end computing solutions providers. Think servers, high-performance computing, AI systems, private cloud and storage, all designed and manufactured in-house under the Tyrone brand. That last part matters. It's a full-stack make-in-India player which puts it right at the center of India's drive for sovereign AI compute. The business rests on three pillars: AI systems, high-performance computing, and private cloud, and it's essentially debt-free while doing it. FY26 was a landmark year. Revenue came in at 2,184 crore rupees, up 90% year-on-year. Profit after tax hit 206 crore, up around 81%, with a PAT margin near 9.3%. And the standout, the AI systems segment grew 460%. Operating EBITDA margin held at roughly 13.3%. These aren't incremental improvements. This is a company nearly doubling in a single year. The trajectory is stunning. Revenue has gone from about 247 crore in FY22 to over 2,100 crore in FY26, nearly 9 times in just 4 years. That's a 5-year sales compound growth rate near 50% and profit growth even faster at roughly 96% a year. Very few listed companies of any size compound like this. The question is always whether it's sustainable, and that's where the AI engine comes in. I am referring to the fact that AI systems now make up 43.4% of revenue, up from almost nothing a couple of years ago. That's a total transformation of the business mix. But here's the nuance. A big chunk of FY26 growth came from one large lower margin strategic order. Strip that out and the base business still grew about 41%, which is still strong, but a long way from the 90% headline. So context matters. What really stands out is the balance sheet. Netweb is essentially zero net debt, ending the year with net free cash of around 83 crore. Return on equity has run near 29% over 3 years, and return on capital employed sits around 32%. Those are excellent capital efficient numbers. And management is not shy about the future. They've guided for 35 to 40% revenue growth with 13 to 14% EBITDA margins over the next couple of years. And they've got the visibility to back it up. Netweb entered FY27 with an order book of roughly 2,100 crore, about 2,400 including likely to win orders, on top of a pipeline near 4,400 crore. There's no major capex planned. They've already added a new 15,000 square foot facility for dense liquid cooled systems. So the runway is funded and the demand is clearly visible. What risks should you be looking at? Number 1, valuation. At around 130 times earnings and 40 times book value, this stock is priced for perfection. Any stumble on growth could derate it fast. Number 2, on the 1st of July, the board approved a fundraise of up to 1,200 crore rupees. For a company that says it needs no major capex, that's potential dilution you'll want to understand. And number 3, promoter holding has quietly slid from about 75% to 67% in 2 years. So what's the chart saying? The long-term trend is clearly up. The price near 4,400 sits well above both the 50-day moving average around 3,700 and the 200-day near 3,400. But momentum has cooled. After running hot in June, the RSI has drifted back to neutral, and at least one system downgraded it from strong buy to just buy in early July. So what's already priced in? The bull case is obvious: a structural AI tailwind, a debt-free balance sheet, and 35+% growth guidance. The bear case is just as clear: an extreme multiple, dilution risk, and lumpy order-driven quarters. Interestingly, the average analyst target sits around 46.75, only about 6% above the current price. In other words, the market has already baked a lot of the good news into the stock. So here's the verdict. Fundamentally, Netweb is a high-quality, debt-free, high-return business involved in India's AI infrastructure build-out. The catch is entirely the price. At these multiples, the business has to keep firing on all cylinders just to justify where the stock already trades. Great company demanding valuation. The core tension: you're paying a premium today for growth that has to show up tomorrow. Remember, this video is analysis, not financial advice. If this breakdown helped, hit like, subscribe for more deep dives, and drop a comment. At 120 times earnings, would you buy Netweb or would you wait? Thanks for watching, and I'll see you in the next one.